RJTI charts versus oh no, we want no part of the rally that commenced in April 2025. What we've learned is that it's okay to pass up on buy or sell trends. We've learned that every bull rally or bear decline doesn't have to be participated in, and although it might seem painful to not be involved with the ups, rallies for any stocks. But you can't ignore the warning signs when these situations arise, and we must admit the rally since April 2025 has been impressive. Although it's laced with so many unrelated variables, especially when earning reports take a backseat to rhetoric or word pumping the markets higher because it's within one's power to be able to do so. Bassett, Trump, or Musk are skillful marketing personnel, and they are very powerful men who have great influence over the markets. But I must admit, they can do what they want since they hold such powerful positions in government. But it's not just the government authority, it's also CEOs of great companies like NVIDIA, Apple, Tesla, Meta, etc. that are guilty as charged from using their position to inspire company stock value higher. And you know what? It's their right to exercise whatever power they have within their reign to promote a happy picture to send stocks screaming higher. But we ain't playing on that field with them. Neither are we going to get in the huddle to call a play or join to create a method of defense to push the markets further from lower trade levels. And the reason we aren't is because the markets are recovering from what we forecast to be a 10,000 points decline to occur for the DJ30, and we did it before most even saw what was coming until they found themselves in the storm. The power of our algorithms are our guide, and they have instructed us to not get caught up in this Humpty Dumpty rally, but to tell the truth from what we see based from our algorithms. Folks, who can argue against the fact that earnings reports are the core of any company, and when such reports are a beat or favorable, it is good for the company and its stock price, especially when good earnings reports are coupled with positive future guidance, is also attached to. Yet this is where the fundamentals seem to err, and that is believing that fundamental analysis is a definitive summary, and yet it's a known fact that such is furthest from the truth. When markets are moving as they are since April 2025, it encourages one to buy, and you also have those like Jim Cramer, Tom Lee, etc., and other financial news reinforcing that you should be buying right now. And if you don't, you'll miss out. Who wants to miss out? So you dive in, and we must admit, it looks like the rally wants to challenge our top sell level called from a year ago for the DJ30, SP 500, NASDAQ. You know, the sell projection from over 12 months ago when the markets were acting in the same fashion as it is now. And the truth of the matter is, the higher the markets go, the more invincibility is to increase from buyers, and the environment will feel so right. And many will look at their portfolio and say, hey, my portfolio recovered all of its losses. Everybody will dance and feel jubilant. Aha! Folks, if gold manages to work toward the 2,900 to 3,100 range, is a lovely day. Secondly, if the equities rally further, then the question is, do you know what an Alka-Seltzer is? And have you ever watched it react once dropped in the water? Fizzle, fizzle. Many will not understand how such a strong rally since April 2025 moved opposite of their expectations. Are we suggesting that a significant drop is in store again? We will point you to a few things, and they are: the VIX is to pop again. Gold is to climb higher than its 3,500.25 high. Treasury yields, short to mid time frames, will rise, but longer term from a 1 to 4 quarters window will drop from a flight to quality, which is a 90% probability versus the FOMC being the reason why Treasury yields plummeted. Yet the greatest issue at hand is that the April 2025 rally was ill-advised from our algorithm's eyes. And because of such zealousness from buyers to ignore a few factors when it comes to historic norms. The strongest beatdown will occur in the equities. How I see the laws of physics and the laws of mathematics offering that the commandment from each deems that the markets have to retreat. Give back 3/4, if not 4/4 of its gains. And this is where the rubber will meet the road, because such a decline is to spook investors, and because of such has a high degree of taking the markets even lower than April's 2025 low. We understand this seems implausible for the markets as of May 13, 2025 are screaming, and everything seems right. The recovery is great because trade levels are returning to November 2024, February 2025 highs. So how could the market ever, or should I say, fund managers consider down is coming when they've worked so hard to get the markets out of the hole? And the politicians are word pumping the markets higher at any opportunity they can. The best way I can answer is, first of all, the highs between November 2024 through February 2025 were values that fell outside of our normal bell curve model and was value that was built on quicksand in the first place. From overzealousness, and although this may be even more alarming that a push higher than November 2024, February 2025 could occur, it still would be levels that are outside of our normal bell curve model. Are we saying that the 6100 SP500 shouldn't have traded? No. But what we are saying is that the 4100 level, or better yet, the 3500 to 3700 level revisit would have been a better retracement for a more solid long-term trade up to the SP500, 6500 to 8000 range. But the fact that less than a 15% correction has occurred and a hocus-pocus rally that is taking place presently is the recipe of disaster predestined for tomorrow. But who sees this? When we forecast in year 2024 that a 10,000 point drop was coming in 2025, we saw it. And only when it became reality, where those like Cathie Woods, Bill Ackman, Goldman Sachs, Jim Cramer, Elon Musk, and a slew of other Wall Street gurus danced to salvage and provide theses on why the markets was doing such and how to navigate this downturn. Yes, we saw it. So the good news is that we get to walk on the plank again, to put our head on the chopping block, to find humiliation if we're wrong, and to feel the pain of loss from our failure to have seen the next coming market move and we were inaccurate. This is the good news. The bad news is, what if our algorithms are right? What if everything we're telling you now becomes market reality tomorrow? What if a black swan we see embedded does surface, or our global pessimism unfolds for a country that could be the culprit to get the ball rolling for the bad? Or what if our other angles come into play? Trouble aerospace and defense, real estate, or even an unexpected decline for the oil companies that helped to spur market concerns previously when crude oil went negative for the first time in history and we had a downside target of $15 a barrel from our sales signal at $107 a barrel. Or what if one of the global banks we have earmarked actually hits that brick wall we see coming for one, if not two, global banks? The laws of physics is superior of all moving things, and the laws of mathematics is definitive. And when both agree that an event is to occur for the good or the bad, or that moves opposite of the commandments from physics and mathematics must conform. This is how we see the markets, and this is why we see trade levels much lower. It is easy to see the trees that make up the forest, and it's even easier to see the forest that's made up of trees. But it's not so easy to see behind the forest. Get your Ramo today. RJTICHARTS.com, driven by infinite wisdom and its proprietary trade systems.